Hey, good morning once again, options traders. Well, I wanted to cover a topic that I've talked about in different forms before, but it's the price and risk myth. Or, in other words, does low price mean low risk? And I decided to revisit this topic because I'm hearing so many traders still fall into this trap. No matter how many times this topic is covered, people just refuse to see the risk reward connection, and it can cause some really bad trading decisions. So let's go have a look at the price and risk myth. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So, first of all, what do we mean by price as risk? Well, let's say that we have a $100 call trading for 3. Traders will say they're risking $3. Well, what if the 105 call is trading for a buck? Well, now traders will say they're risking less. Well, the question that we want to address here today is price the same thing as risk? Is this really the best way to understand risk? Well, to do that, we have to back up and ask, what is risk? Well, there's really a lot of different definitions of risk, but overall, one that is probably the most consistent in finance is that it's simply the probability that you will end up with a loss. If there is a high probability for loss, then makes sense to say that it's high risk. If there's a low probability for loss, then we will say it's low risk. So the thing to understand right now is that risk is not defined by the amount of money in the trade. Why? Because risky assets cost less and safe assets cost more. Well, why is this? Well, now we have to come back to the risk reward connection. The thing to understand is that all investments are priced according to risk. And if an asset has a lot of risk, traders will bid the price down or push that price lower. They're going to say, I'm not real wild about owning this. Yeah, I'll buy it if I can get it for a lower price and make it worthwhile. On the other hand, if an asset is relatively safe, traders will bid the price up or push that price higher. They're willing to pay more because there's a smaller chance that they're going to end up with a loss. And this is the risk reward connection. Now, again, no matter how many times I cover this, people still refuse to see it for what it is. They still want to say if I'm paying $1 for an option instead of 3, I'm risking less. So, to show that that's not true, let's play a pricing game. And the question that you have to answer is how much would you pay for the chance to win $100? So let's say that we're in a room and I'm up on the stage in the front and I'm holding up a $100 bill. And it's your job to bid on it. Whoever is the highest bidder gets the $100, or at least gets to play the game. So here are the games that you get to bid on. And game number 1 is guaranteed. So it's just a matter of being the high bidder. So we start the bidding process and suddenly somebody says, hey, I'll pay $10. Well, no kidding, I'll bet you would. Pay $10 to get a guaranteed 100. And somebody probably will throw that out there for a bid. But somebody else will quickly realize that's a really good deal. So why not bid more? It'll get pushed to 20 and then 30, 40, 50. Those bids are going to quickly climb, and we might see it go out at, let's say, $99. Now, technically speaking, if there's no difference in time, it's not like you have to wait a year to get this, that should be priced at $100. Because really what you're doing is just making change for $100. If you go into a bank and give them 520s, you should expect $100 back, not $99. But just for the sake of the argument, let's say that somebody pushes it up to 99, nobody wants to push it higher, and that becomes the price of our game. All right, so that's game number 1. Let's revisit that in a moment, but for right now, let's go to game number 2. Game number 2 is the same idea, but now we're going to flip a coin. If you are the high bidder, you get to come up to the stage and flip a coin, and if it lands heads, now you get the $100, but if it lands tails, you lose the amount that you bid. All right, so we open up the floor for bidding, and we hear somebody say, I'll pay $10 for that. Somebody goes, I'll go 20, 30, 40. We'll start maybe slowing down. We might see it go up to 45. Theoretically, this one's worth 50, but again, because people are risk averse, we might see it fall a little bit below 50. But just again, for the sake of the argument, let's say that it goes out at 45 bucks. That's our high bidder. All right, hold that thought. Let's go on to game number 3. Game number 3, same idea, but now you have to come up and draw from a deck of cards. And if you draw the ace of spades, now you get the 100 bucks. Otherwise, you lose the amount that you bid. So we open up the floor for bidding, and traders are going, this is looking awfully risky. I'll give you 10 cents for it. Somebody goes, I'll go 20 cents, 30 cents. Maybe we get a buck. But do you see what's happening? People recognize that it's not a very good game to play, so they're not willing to pay a lot for it. Okay, so now let's go back and revisit all of these games. The first game was a guaranteed game, and we assumed that we got 99 bucks for it. So I could restate this as an opportunity or a strategy where you could pay $99 to make one. Right? If you pay $99, if you're the high bidder, you walk away with 100 bucks in your pocket after paying 99 for it, so you're better off by a buck. For the coin game, we were priced at 45 bucks, and if you win, remember it's not guaranteed, but if you win, you are effectively paying 45 to make 55. You paid $45 to play, you walk away with 100 bucks, you are better off by $55. And then finally for the card game, let's say we got a buck for it, I could restate this as an opportunity to pay $1 to make 99. Okay, so look what happened. As we moved from the guaranteed game to the coin game, we are introducing risk. We're making things more uncertain. And how did the crowd respond? The crowd responded by pushing the price down from 99 to 45. And what did that do for the reward? Well, it pushed it up from 1 to 55. As the price comes down, the reward goes up. Why did the price come down? Because the risk went up. As we went from the coin game to the card game, what happened? We increased the risk even more. How did the crowd respond? Well, they pushed the price down from 45 down to 1. And what did that do for the reward? We went from 55 to 99. So you can see very clearly what happens is that as you increase the riskiness, people recognize that they don't want it, relatively speaking, but they respond by pushing the price down, and that in turn is what makes the reward go up. So something else to understand is that price is the equalizer. You've heard me say this a million times, but price makes all investments equally attractive, at least in terms of risk. So that's why it's also wrong to say that one strategy or option strike or expiration is better. Because if it's better, it's been priced in. So if we go back to our games right here, I can't really say that any of these are better. I can't say the guaranteed game is better. Yes, all things equal, I think people would much rather have it guaranteed, but you got to pay for it. And in response, you're not going to make a lot from it. So all of these great properties that we get from having a guaranteed game have to be priced in. Now also, should we look at the card game and say that it's horrible? Well, not really. It's been priced in. It's not going to cost you a lot. And if you win, there's a potentially very large reward. It's been factored in. So as we start looking at these different strategies, let's say, we can't really say that one is better. What we should say is that they are simply different. And the reason is price. Now, once you understand this risk-reward connection, you'll understand another fallacy that you'll hear out there. A lot of traders will show you strategies or techniques or different strikes, whatever, and they will say, this is going to minimize your risk and maximize your reward. Well, now that you understand the risk-reward connection, is this possible? Can you minimize the risk while maximizing the reward? Well, let's go back to our games. And if you could minimize the risk, it means that you're playing this game, that's the one with the minimum risk, but that you could somehow get this reward. So you can play the guaranteed game but get a $99 reward. Not true. You can't cross over like this. If you want the $99 reward, you've got to play this game. And that's going to allow you to pay $1. So again, this whole idea about minimizing risk and maximizing reward is completely false. Now, it is true that you can maximize the reward for a given level of risk, But you can't minimize one variable while simultaneously maximizing the other. You cannot minimize risk and maximize reward. Instead, as an options trader, you get your choice. So we can see this whole idea of risk and reward and the fallacies that people step into with a risk graph. Let's say that the stock is 100, and I think I priced this as a 30-day call at about 25% volatility. The $80 call is worth about $20.10. So remember, this is really a 10-cent option. There's $20 of intrinsic value. Now, again, traders will look at this and say, yeah, but that's over 20 bucks and I could lose that. If I buy the at the money $100 call, pricing model says that's worth 3 bucks. And so in their mind, they're saying, oh, I'm minimizing the risk. I'm reducing it from $20.10 to 3. Well, but remember where the stock is. It's up here at 100. You've got a 50-50 shot of losing your 3 bucks. This is like the coin game. People are not going to be real eager to pay full price when the stock is right there at that strike. You've got a much higher probability for losing your 3 bucks than you do down here with the $80 call. So hopefully you see the fallacy, because if you really think that paying less for an option is reducing the risk, well, go in the other direction. Come out here and buy the 110 call that's only trading for 30 cents. And you can say, well, now I've really minimized my risk and I've maximized the reward. I can still make an unlimited amount just like I can with the 100 call here in blue and just like with the 80 call here in black. I can still get the maximum reward, but I've minimized my risk. Not true. What you've done is you've virtually guaranteed that you're going to lose your 30 cents. We can also see down here, look how far the $80 strike is away from the current stock price. Very low chance that that's going to go out worthless. But if you look at the 110 strike, stock's got to move 10 points just to make it at the money. Then it's got to move another 30 cents just to break even. And we've only got 30 days for that to happen. There's a much higher chance, virtually 100% chance, you are going to lose your entire premium. So yes, if you buy this call, this 110 call here in red, you are limiting the amount you can lose. But you're nearly guaranteed to lose it. And guaranteeing consistent losses is hardly a good trading plan. So always remember, there are many moving parts with any decision. And because of this, good decisions can have bad outcomes. But if you see price as risk, you're increasing the chances for good trading ideas to quickly turn into bad ones. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.